Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hang Lung Group Limited interim report. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand or sustain the business. Hang Lung Group Limited is a diversified company that operates through various segments to provide a wide range of businesses and services. The company's primary focus is on property development and management, which includes developing properties for sale and lease across different types such as retail, office, residential, and serviced apartments. In addition to property development, Hang Lung also operates hotels, shopping malls, office and industrial premises, residential premises, and car parking bays. This indicates that the company has a significant presence in the hospitality and real estate sectors. Furthermore, it offers various services including property management, financial services, apartment operation and management, property agency, hotel investment services, and property investment services for rental income. Overall, Hang Lung Group Limited's business operations span across multiple industries, making it a comprehensive provider of property-related services and businesses in Hong Kong and mainland China. Hang Lung Group's stock price has experienced a remarkable surge of 63.07% over the past year, surpassing expectations and outperforming its peers. Several key events have likely contributed to this significant growth. One major factor is Hang Lung's commitment to sustainability. In May 2025, the company announced that it had increased its portfolio of renewable energy-powered properties in mainland China from 50% to 80%. Marking a significant step towards its 2050 net zero goal. This achievement has likely attracted environmentally conscious investors and reinforced Hang Lung's reputation as a leader in sustainable development. Another key event is the expansion of Hang Lung Properties commercial project on West Nanjing Road in Shanghai. In December 2025, the company secured a 20-year operating lease for the number 1038 West Nanjing Road commercial project, expanding its total gross floor area by approximately 44%. This partnership with Shanghai Joinbai Group Co., Limited, is expected to bolster Hang Lung's leadership position in core cities and reinforce Shanghai's status as an international consumption destination. While Hang Lung's 2024 annual financial results showed a decline in net profit attributable to shareholders, the company reported an 8% increase in overall revenue. However, this event is unlikely to have been a primary driver for the significant stock price increase. Overall, Hang Lung Group's commitment to sustainability and its strategic expansion plans have likely contributed to its impressive stock price growth over the past year. The primary drivers of revenue growth or decline can be identified through an analysis of the key performance indicators presented in the summary. On the growth side, property leasing has emerged as a significant contributor, with a substantial increase of $831 million in 2025 compared to 2024. This is complemented by a 6.2% rise in Hong Kong sales revenue and a 2.1% increase in mainland China leasing revenue. Hotels revenue has also seen an impressive 86% surge, while residential and serviced apartments have experienced an 11% growth due to the talent admission regime and expanded customer base. These positive trends suggest that the company is experiencing significant revenue growth across various segments. On the other hand, there are areas where revenue decline has been observed. Mainland China sales revenue has decreased by 4.5%, while Hong Kong retail portfolio has seen a 7% drop in revenue. The office market remains in a protracted recovery phase, and property sales have declined by 0.7%. These declines highlight the need for strategic interventions to mitigate these losses and stabilize revenue streams. Net income experienced a mixed trend between 2024 and 2025. On one hand, it decreased by 12.6% in RMB and 14.2% in HK dollar from 2024 to 2025, indicating a decline in profitability. However, on the other hand, net income increased by a significant 115% during the same period. The change in profit margins provides further insight into this trend. Operating profit margin saw an increase from 40.6% HK dollar and 40.3% RMB in 2024 to 55.3% HK dollar and 54.4% RMB in 2025, indicating improved operational efficiency. Conversely, net interest expense margin decreased from minus 27.5% HK dollar and minus 28.1% RMB in 2024 to minus 37.1% HK dollar and minus 39.2% RMB in 2025, suggesting a higher burden of interest expenses. The contrasting trends in net income and profit margins suggest that the company's profitability was affected by various factors during this period. While improved operational efficiency contributed to increased operating profit margin, the rise in interest expenses likely offset some of these gains, leading to the mixed trend in net income. The company's financial performance has shown a significant improvement in recent years. One key indicator of this success is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various expenses, resulting in a net inflow of funds. This achievement is a testament to the company's efficient management and effective strategies. The ability to generate positive operating cash flow allows the company to invest in growth initiatives, pay off debts, and reward shareholders, ultimately contributing to long-term sustainability and success. The company's debt level has undergone significant changes in the recent period. While total borrowings decreased by $1,822 million, non-current liabilities increased by a substantial amount of $1,815 million. This indicates that although the company may have reduced its short-term borrowing, it has taken on more long-term debt obligations. As a result, the net debt balance has also increased from HK $46,977 million to HK $48,496 million. In terms of interest expenses, there is a notable increase in both net interest expense and finance costs. Net interest expense rose by $66 million, while finance costs increased by $50 million. These increases suggest that the company's debt obligations are becoming more costly, which may have implications for its future financial performance. Management is optimistic about the company's outlook, citing strong fundamentals that provide a solid foundation for growth. Key initiatives such as the Phase 2 development of Center 66 are expected to drive long-term development and support the company's expansion plans. The management team is also confident in the company's ability to improve sales and strengthen brand loyalty through nationwide events and marketing campaigns. This strategic approach aims to capitalize on emerging trends and consumer preferences, ultimately enhancing the company's market position. Notably, malls are performing well despite some restraint in high-end spending among customers. The company is leveraging this resilience to consolidate its leading position in Shanghai as a lifestyle landmark. Furthermore, the Spring City 66 Mall is poised to further solidify its status as a premier retail and lifestyle destination in southwestern China. Overall, management's outlook suggests that the company is well-positioned for growth and success, driven by a combination of strong fundamentals, strategic initiatives, and market resilience. The company's financial performance has been marked by a commitment to rewarding its shareholders. As per the provided information, the company has indeed paid dividends in recent years. Specifically, an interim dividend of HK $21 was declared for 2024, while a final dividend of HK $65 was approved and paid out in 2023. This demonstrates the company's focus on returning value to its shareholders through regular dividend payments. The absence of any mention of share buyback or repurchase suggests that the company has chosen to prioritize dividend distributions over other forms of shareholder return. That concludes the financial summary for Hang Lung Group Limited. Feel free to comment below, and I will be happy to answer them when possible.